In the wake of a dramatic 74 basis points (BPs) surge in 10-year yields, we find ourselves in a pivotal moment for the global financial system. This surge is set to result in approximately $140 billion in unrealized debt losses on U.S. bank balance sheets. To put this in context, U.S. banks collectively held $5.4 trillion in total duration exposure at the close of Q2. The magnitude of these cumulative unrealized losses is poised to reach an all-time high of $700 billion, potentially necessitating an expansion of the Federal Reserve's temporary bank bailout facility. However, the repercussions extend far beyond the banking sector. A pressing question arises. What about the broader impact on the entire fixed income asset class? These soaring yields are not only affecting banks but are rippling through an asset category traditionally considered the bedrock of ultra-safe collateral in the global repo market. The result? Potential massive margin calls, affecting a wide spectrum of investors. Earlier this week, we discussed the implications of the recent 74 basis points (BPs) spike in 10-year yields, which was projected to result in roughly $140 billion in unrealized debt losses on the balance sheets of U.S. banks. This was particularly concerning because, as of the end of Q2, these banks held a total duration exposure of $5.4 trillion. Consequently, this surge in cumulative unrealized losses could reach an all-time high of $700 billion, potentially necessitating an expansion of the Federal Reserve's BTFP temporary bank bailout facility. However, amidst these discussions, a crucial question has arisen. What about the total cumulative losses experienced by all investors in the fixed income asset class? It's not just banks that are suffering from the soaring yields. These losses affect an asset class traditionally considered ultra-safe collateral in the global repo market, with potential ripple effects leading to substantial margin calls, both within and outside the banking sector. To illustrate this point, consider the example provided by DB's Jim Reed, involving the Austrian 0.85% 2120 government bond. In December 2020, its cash price reached a high of €139.40, but it recently plummeted to as low as €32.10, marking a significant loss of approximately 77%. There are other examples as well, such as long-dated index-linked gilts, which have experienced capital losses of up to 85% from their peaks 2 years ago. For instance, the 0.125% 2073 linker was issued at £355.94 less than 2 years ago and traded at £396.95 shortly thereafter. It was trading under £60 recently. Furthermore, Reed discusses the 2068 UK linker, offering a more extended historical perspective. One striking illustration is the 2118 Austrian zero-coupon bond, which was trading near par when issued 3 years ago, but has now dwindled to around 4 cents. Those who believe in the possibility of deflation or QE resurgence are undoubtedly eyeing this issue as a golden opportunity. Although these are extreme cases due to their long durations, they provide insight into the substantial devaluation of global debt over the past couple of years. To quantify this, consider a rough estimate. The Institute of International Finance suggests that by the end of H1 2023, there was $307 trillion in global debt outstanding. Face value. However, much of this debt isn't publicly tradable, as indicated by the Bloomberg Global Ag Index, which had a peak market value of nearly $70 trillion almost 2 years ago. The same index shows a total return down approximately 23% from those peak levels a few years back. Taking these factors into account, Reed's back-of-the-envelope calculation reveals that around $16 trillion in global market value has been eroded over the past couple of years at the index level. If we apply this negative total return to the entire global debt pile, it implies a value destruction of approximately $70 trillion over the same period. To put this in context, the global equity market is estimated to be worth about $107 trillion. and the IMF projects the global economy's worth to be $105 trillion in 2023. It's important to acknowledge that this calculation is simplistic because the Global Ag Index represents only investment-grade rated debt and doesn't encompass the entirety of global debt. A significant portion of debt is held to maturity, has varying durations, and is not marked to market. Additionally, debt is often used to offset liabilities, potentially mitigating the impact of sharp declines. Nonetheless, whether the actual value destruction is closer to $16 trillion or $70 trillion or somewhere in between, the losses incurred in debt markets due to the Federal Reserve's policy of keeping rates exceptionally low for an extended period and now rapidly increasing them represent the largest in history in terms of dollar value and relative to GDP. Reed leaves us with a rhetorical question. Can the system absorb these losses without further mishaps? The answer is unequivocally no, and if they were to craft a sequel to Margin Call, this would be the pivotal moment when Sullivan discovers the extent of the losses